Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. The dominant question facing investors today is no longer whether inflation is falling or whether the Federal Reserve will cut rates. Instead, the more important question is how politics is reshaping the macroeconomic landscape. As the United States moves closer to the 2026 midterm elections, policy decisions are increasingly influenced by electoral incentives rather than purely economic objectives. That shift changes how investors should interpret everything from tariffs and fiscal policy to trade and geopolitics. In today's report, we'll examine the latest political probabilities, evaluate the outlook for Congress, assess the health of U.S. government finances, and explain why political volatility may rise even as the underlying U.S. economy remains comparatively resilient. The first chart illustrates how market expectations for the 2026 midterm elections have evolved over the past year. Perhaps the most striking development is the steady rise in the probability of Democrats regaining unified control of Congress. Current prediction markets assign roughly a 43% probability to a Democratic sweep, making it the single most likely outcome. At the same time, the probability that Republicans retain both chambers has declined to below 20%. This reflects a familiar historical pattern. Midterm elections have traditionally served as a mechanism for voters to rebalance political power. Incumbent presidents often face declining approval ratings as economic frustrations accumulate, regardless of whether underlying macroeconomic fundamentals remain healthy. At the same time, markets continue to assign a meaningful probability to divided government, with Republicans retaining the Senate while Democrats reclaim the House. That scenario has become almost as likely as a Democratic sweep. For investors, this distinction matters far more than partisan politics alone. A divided Congress would significantly constrain large legislative initiatives. Tax reform, major spending bills, and broad structural policy changes would become increasingly difficult to pass. That reality forces the White House to rely more heavily on executive powers rather than congressional legislation. Instead of pursuing politically difficult domestic reforms, the administration is likely to emphasize areas where presidential authority remains strongest, including tariffs, sanctions, foreign policy, border security, and industrial policy. Think of it like driving on a highway where several lanes are suddenly closed. Traffic doesn't stop, it simply gets redirected through the remaining open lanes. Likewise, policy implementation shifts toward executive action when legislative avenues become blocked. This explains why investors should expect political headlines to become more frequent over the coming year, even if the broader economic trajectory remains relatively stable. Turning to the House of Representatives, the electoral map reinforces why Democrats currently enjoy a favorable outlook. Republicans enter the election with only a narrow majority, leaving very little room for underperformance. Even modest swings across competitive suburban districts could be sufficient to transfer control of the chamber. The map highlights a large number of Republican-held districts that remain competitive, particularly across suburban regions, where demographic shifts have steadily altered voting behavior over recent election cycles. Although Republican-led states have attempted to improve their electoral positioning through redistricting, the arithmetic remains challenging. Democrats do not require a landslide victory. They simply need to flip a relatively limited number of competitive districts. This illustrates one of the most important principles in electoral forecasting. Winning the popular vote is far less important than winning the right districts. Political geography often determines congressional outcomes far more than national polling averages. For markets, a Democratic House would almost certainly lead to greater legislative gridlock. Large fiscal packages become increasingly difficult to negotiate, reducing the probability of substantial new spending initiatives. Ironically, financial markets often respond positively to periods of divided government because policy uncertainty surrounding major legislation declines. Investors can focus more on corporate earnings and economic fundamentals rather than sweeping policy changes. However, legislative gridlock also increases the administration's incentive to rely on tariffs and executive actions that do not require congressional approval. As a result, while domestic policy may become more constrained, international trade policy could become considerably more active. The Senate tells a very different story. Unlike the House, Republicans currently retain structural advantages that make holding the Senate considerably easier. Current projections indicate Republicans maintaining a narrow majority of approximately 51 seats versus 45 for Democrats, with only a handful of truly competitive races remaining. The reason lies in electoral geography. Many of the seats Democrats need to defend are located in politically competitive states, while relatively few Republican-held seats present realistic pickup opportunities. States such as Georgia, Michigan, Maine, and North Carolina will receive enormous attention over the coming months because relatively small changes in voter preferences could determine overall Senate control. Maintaining the Senate carries significant implications beyond legislation alone. The Senate confirms federal judges, cabinet officials, regulatory appointments, and many executive nominations. Even under divided government, retaining Senate control allows an administration to continue shaping long-term institutional policy. From a market perspective, this suggests a scenario where legislation slows, but executive authority remains highly influential. Investors, therefore, should pay close attention not only to election polling, but also to legal developments surrounding executive powers. Recent court rulings have already forced the administration to adjust its tariff strategy, moving away from broad emergency powers toward more targeted legal authorities such as Section 301 investigations. Rather than disappearing, trade policy is simply evolving into a more selective and legally durable form. Political strategy cannot be separated from fiscal realities, and this chart illustrates the government's underlying budget dynamics. Government revenues continue growing at a healthy pace, while expenditure growth has moderated significantly following the extraordinary pandemic period. The gap between these two lines has narrowed considerably compared with previous years. That represents an encouraging development because improving revenue growth naturally reduces fiscal pressure without requiring aggressive spending cuts. One major contributor has been stronger tax collections, supported by a resilient labor market and continued corporate profitability. Another increasingly important contributor has been tariff revenue. Although tariffs are often discussed primarily as trade policy, they also function as a meaningful source of government income. Every dollar collected through import duties partially offsets federal borrowing requirements. This explains why tariffs remain politically attractive. They simultaneously generate revenue, reinforce domestic manufacturing narratives, and demonstrate visible executive action without requiring congressional approval. Looking ahead, if inflation continues moderating while government revenues remain healthy, fiscal pressures become more manageable despite elevated spending levels. For investors, the key takeaway is that fiscal sustainability depends not only on spending restraint, but equally on maintaining robust revenue growth. As long as economic activity remains resilient, government finances can gradually stabilize even without dramatic fiscal reforms. This longer-term perspective places today's fiscal position into historical context. The fiscal deficit remains elevated by historical standards, although conditions have improved substantially from the extraordinary pandemic-era peak. Today's deficit ratio sits near levels experienced during previous periods of economic expansion rather than recession. That distinction is important. Normally, governments accumulate larger deficits during downturns as tax revenues decline and stimulus spending increases. Running relatively large deficits during periods of solid economic growth is much less common. The implication is straightforward. The United States continues relying on significant fiscal support even while unemployment remains low and private sector activity remains relatively healthy. That creates both opportunities and challenges. On one hand, continued government spending supports economic growth and corporate earnings. On the other hand, sustained deficits increase Treasury issuance, placing upward pressure on long-term interest rates and expanding future debt servicing costs. Political incentives further complicate the picture. With elections approaching, neither party has strong incentives to pursue meaningful fiscal tightening. Spending reductions are politically unpopular, while tax increases remain equally difficult. Consequently, policymakers increasingly search for alternative revenue sources, including tariffs, stronger tax collections, and policies designed to encourage domestic investment. Rather than expecting rapid fiscal consolidation, investors should prepare for gradual adjustment supported by economic growth rather than aggressive austerity. Trade dynamics provide another important piece of the broader macro puzzle. This chart shows exports continuing to strengthen while imports have recently rebounded sharply following earlier weakness. Meanwhile, the trade deficit remains sizable despite ongoing tariff policies. At first glance, some investors may interpret this as evidence that tariffs have failed. The reality is considerably more nuanced. Tariffs rarely eliminate trade deficits altogether. Instead, they alter sourcing patterns, encourage supply chain diversification, and gradually reshape corporate investment decisions. Companies adjust slowly because global supply chains resemble massive cargo ships rather than speedboats. They require time to change direction. The recent rebound in imports likely reflects businesses accelerating purchases before additional tariff measures potentially take effect. This front-loading behavior has occurred repeatedly during previous trade disputes as firms seek to secure inventory before costs increase. Meanwhile, exports continue benefiting from relatively resilient global demand and improving competitiveness across several advanced manufacturing sectors. Looking forward, we expect trade tensions to remain a defining feature of U.S. policy, regardless of specific legal developments. Rather than broad, universal tariffs, future measures are more likely to target strategic industries, including semiconductors, advanced manufacturing, critical minerals, and technology supply chains. The objective is not simply reducing imports, but strengthening long term industrial competitiveness. For markets, this means persistent geopolitical headlines without necessarily implying significant deterioration in overall economic growth. Finally, we examine one of the most encouraging developments within the fiscal picture. Monthly tax revenues have increased dramatically over the past year, while cumulative revenue growth remains exceptionally strong despite some recent moderation. This surge reflects multiple factors. A resilient labor market continues generating healthy income tax collections. Corporate profitability has remained stronger than many economists anticipated. Financial market gains have also supported capital gains realizations and associated tax receipts. Combined with tariff revenues, these developments have materially strengthened government income. The recent moderation in growth should not be interpreted as deterioration. Instead, it reflects normalization following exceptionally strong comparisons during previous quarters. Viewed over the broader trend, tax revenues remain comfortably above pre-pandemic levels and continue supporting federal finances. This reinforces one of our central macro themes. Despite elevated political uncertainty, the underlying U.S. economy continues displaying remarkable resilience. Consumers remain active, businesses continue investing, and government revenues reflect that strength. Political headlines may dominate financial news, but economic fundamentals often evolve much more gradually. That distinction is precisely where long-term investment opportunities emerge. Markets frequently overreact to short-term political developments while underappreciating structural economic trends. Recognizing the difference between temporary political volatility and lasting economic change remains one of the most valuable competitive advantages for investors. As we conclude, our baseline outlook remains constructive on the U.S. economy despite rising political uncertainty. We expect inflation to continue gradually moderating, allowing the Federal Reserve greater policy flexibility over time. Meanwhile, the approach of the 2026 midterm elections is likely to shift policy toward executive actions, particularly through tariffs, trade measures, and geopolitical initiatives, rather than sweeping domestic legislation. For investors, the key is to separate political noise from economic reality. Elections will generate headlines, but the underlying macro backdrop remains more resilient than many expect. Fiscal revenues are improving. Corporate earnings continue to benefit from structural investment themes, and the United States remains better positioned than most developed economies. Outside the United States, we continue to maintain a cautious view on China. Structural challenges, including weak property markets, deteriorating demographics, subdued private sector confidence, and persistent geopolitical tensions, continue to weigh on its long-term outlook despite periodic policy stimulus. Thank you for watching YCC Capital Macro Research. We look forward to seeing you in our next analysis.